Is the industry running out of gold reserves, and what should we make of the mega mergers we've been seeing? Joining me now at the PDAC is Sean Boyd, the CEO of Agnico Eagle. Sean, welcome back.
Thank you.
I'm excited to have you on as one of the largest miners in the industry here. We're going to talk Agnico in a second, but first let me get your thoughts on the consolidation we've been seeing in the space. We were at the BMO conference together, obviously Newmont, Barrick, the bid there, the big news in our industry. Your thoughts?
It's hard to, when you sort of sit back and just step back from it and not look at the particulars of the deal. Didn't we try this before? Didn't we go through this bigger is better? That didn't quite work. In fact, if you look at the way Barrick was built, it was built around big M&A. And they basically took a fabulous gold deposit in Goldstrike and they added big M&A to it. They're at the point now where I think this is just an outcome of the earlier discussions with Newmont. It's all about competitive jockeying. That's the way we see it. The top 5 gold companies by market cap, we're number 4. The other 4 have all talked to each other in some form or fashion about putting their businesses together, and we think it's just competitive jockeying.
So when you say that, is it really just the drive to be the largest, the biggest gold producer in the industry?
I think that's part of it. I think that some of the companies don't want to find themselves in third place because then they're at risk of being taken over. I think it's part of that. And if you look at Barrick, Randgold, Newmont does Goldcorp. Barrick says, wait a minute, you'll be bigger than us, so we're going to try to break that one up. Even though it's supposed to be about large and liquid and therefore more valuable, that didn't work before. Maybe there's some angle to reserves. We can see that because that's the biggest challenge we have as an industry is mine lives, but not just the number of ounces, it's the quality of the ounces. So there's some argument there, but in the back of it all, it's competitive positioning.
I think one of the positives that comes from it is that it gets a lot of people talking. There's a lot of schools on thought. Some will say, well, it will give a chance for assets that perhaps weren't given enough attention before to get light shined on them when you see these mega mergers. It cuts a lot of redundancy, a lot of paperwork, a lot of administrative costs. Some will argue that it does create shareholder value. So at least it's getting the industry talking.
We like that. We like that. I think what we need to see as an industry when the dust settles in a couple of years, when the merger and consolidation phase, let's say, ends, what we hope happens as an industry that the right assets end up in the strongest hands. And then we've got a bunch of high quality companies that generalists want to invest in, not because they're gold companies, because they're just great businesses that happen to mine for gold. So we hope that happens, and there is some arguments to eliminating overheads. We get that. I think that's important.
Has it created interest for you? Are there certain assets that you might be eyeing now because of this merger talk?
Not really.
Okay.
We're opening up 2 new mines this year. We can see steady growth in output over the next 5 years, but more importantly, we can see growth in cash flow per share. For us, after 61 years, it's about keeping the share count down. We only have 235 million shares outstanding while we're still building new mines, we're adding production, we've just increased our dividend. It's really about the quality of the businesses. It's not so much about large and liquid. Large and liquid it's important, but if you've got a great business, the investors are going to find you.
And Sean, you've had your first pour at Meliadine. So that's the latest. What's the focus now? What's next?
Meliadine's in the commissioning phase. A week and a half ago, we were happy to be up with the team. We poured our first 2 bars. That construction's gone very well. It's ahead of schedule. It's below budget. We start commercial production there in the second quarter, followed quickly thereafter at Amaruq, commercial production in the third quarter. We should have record output this year, record next year as we hit 2 million ounces. And as we said, we can see the ability to grow that 10 to 15% above the 2 million ounces we expect to hit next year.
Sean, I always appreciate getting your insights. You're one of the longest standing CEOs in the mining industry. What's your sentiment on the space right now? Do you feel good about the mining space right now as a whole?
I feel very good because we started to see about 18 months ago renewed interest, at least in the big pools of money, the non-resource money, starting to do their homework. And we were concluding from those meetings that at some point these big pools of capital were feeling they would have to be in this space. Right now, they're not chasing these stocks. The businesses have improved. The focus is less on big until a few weeks ago with some of these big deals, it's more on the quality of the business. But investors are back. They're not chasing the stocks yet, but the gold price we think has bottomed and it's heading up.
Investors are back in the mining stocks.
Investors are back doing their homework, trying to understand where the highest quality businesses
this year,
are.
the miners outperforming physical bullion. That's telling us something.
Yes, and I think that even though we're losing some of our resource investors, those resource funds are declining in size, there's still a large pool of capital out there that's taking a look at the space.
Sean Boyd, always a pleasure having you on. Thank you so much.
Thank you. Thank you very much.
On. Happy PDAC. It's only just beginning. We'll have much more for you on Kitco.com.